light and with these disclosures and then presentation mistakes that we generally see, and we make sure that those are addressed properly. So without waiting further, I would like to invite Anish ji. Sir, please take
Yeah.
it over. Thank you.
Thank you, Balram, for all your coordination, and you've been really working hard to have this event for the benefit of the members. My namaskar to all senior professionals as well as young professionals, all ladies and all gentlemen. Good evening. Let me first share the slide and let me know if you are able to see this.
Yeah, we can see it.
Yes, clear.
Okay. Some ground rules. As we are going to take few of the disclosures, because we know that IFRS are very vast and all disclosures cannot be covered today. So what we have taken is some of the common disclosures and presentation aspects which requires our attention as professionals and also as management when we prepare the financial statement and when we audit the financial statement as auditors. So as we going to take the slides, maybe I think you might have certain questions. So maybe with each slide, we can take one or maximum two questions, but still if there are more questions on that, we can take at the end so that we can cover all the slides, what we today propose to cover. With this, let's start. This will be our agenda for the day. And let me know if my voice is not audible to you guys or the screen is not visible. Introduction, Rishi Bhai and Balram has already done it. The first topic which we'll cover is some common mistakes when we present the financial statements or when we disclose certain notes in the financial statements. Statements becomes meaningful to every reader. And then at the end, me along with Balram will also take some disclosures which are related to corporate tax. And we have taken two examples from the published accounts. Particularly, this is the first year when the tax has been disclosed and the related notes regarding corporate tax as well as deferred tax. So we have just taken extracts from the published financials and we have put it here so that we can do some kind of discussion on that. With this, moving to the first agenda item, financial statements, presentation and disclosures. Some of the common mistakes, which sometimes willingly, sometimes unwillingly, we do it as management and also as an auditor. So let's discuss one by one. And if we have any questions, happy to discuss there itself. Mistake number one, we all know that IFRS is basically principle-based accounting standards. And the first thing sometimes we ignore is that ignoring substance over form principle. We all know that IFRS plays very high importance to substance over form principle in order to prohibit off-balance sheet financing, to prevent hiding of liabilities or not disclosing it appropriately or losses, or to avoid big accounting scandals, which we have seen in the past like Enrons and WorldComs. So what is substance over form? Let us look into it. Substance over form basically means that we need to account for the transaction in line with its economic substance and not merely in line with its legal form. In most of the cases where we do the audit of the contracts and all, we see that both of these two are the same. However, sometimes this is not true. Sometimes the transaction, let's say just for an example, sometimes the transaction is called lease of an asset. But in fact, when we see the agreement, when we go through the agreement, what we see that the companies have bought the assets and they have funded this asset with the purchase with loan. So basically, then it doesn't become the lease. So if a company does not account for liabilities in this particular case from finance lease in full, then the readers of financial statements will never assess company's liquidity and other indicators correctly, just because big finance lease liabilities are hidden from it. And obviously, if we are subject to audit from the regulators have come to know that we have not treated the transaction as a substance over form principle, they can penalize ignoring this principle. How we can avoid this mistake? We as an auditors, we should always review most of the new contracts entered during the year. Because generally when you review the old contracts, probably it will be carryover, but the newly arranged contracts, we should always do a thorough review and we should ensure that the economic substance is not different from the economic form. If we can see some of the examples of such situations are sales and repurchase contracts, sales and leaseback contracts, factoring of receivables. One of the very important substance over form principle we generally see is agent versus principal. Sometimes companies do want to increase their revenue, and therefore they treat that contract as a revenue agreement. However, when we look into the contracts and other documents, we come to know that they are mere agent in this case, and therefore they should record only the commission. What if we have not done it properly? Maybe revenue was overstated and these financials may have been used for something and wrong interpretation would have been taken by that. A lot of time we also see that the company wants to record the revenue and they do all the documentation linked to the bill and hold. However, only by documentation is bill and hold, whereas I don't know what's happening to the presentation. Whereas actually, in actual terms, the revenue is not there. It's just the materials are lying in the company's premises and the revenue should not have been recognized. Before we move to the next one, do we want to discuss something on this mistake? Is anyone who wants to have can raise their hands or they can put in the chat so that Balram can read it. If no questions, then we can move to the next one.
Yeah, just to repeat, if you have any question, please raise the hand in the reactions.
I think there is one chat, what it says.
More examples.
More examples. This was... So examples, as I said, first one is the... maybe I think we can ask the audience if they have faced this thing that when they look at the transaction is something which is recognized, but when they actually look at the agreement, the form is something else.
Yeah.
Anyone who would like to contribute? So this is a focus group and we should discuss rather than I'm just talking.
Yeah, I can add one example, Anishji.
Yeah.
In the case of tourism, if someone is booking the tickets and hotels, so not every time that they will be acting as principals. Sometimes they may be acting as agents, whereby they only have to recognize commission instead of booking the entire amount. So these things also are generally noticed in some of the cases. Unless we look into it and what is kind of risk and rewards that they are assuming and what kind of role they are playing, so it becomes difficult to identify whether it should be total or should it be only commission to recognize.
Yeah. So I think in this scenario, 2-3 things we have to see: that who takes the risk, who decides the pricing, and who, like in the case of tickets and all, the risk of inventory is not there. But in case of trading, who takes the inventory risk? All these things we have to see. And plus, we also have to see that for the customer, who is the principal? Is the customer treating you as an agent or customer treating you as a principal? So if your customer treating you as a principal, then probably it's a fit case to record the revenue.
Yeah, there is one question in the chat box. If a property is in the name of owner but used by company, can we show it in the company books using this principle?
It's a very tricky question. We have seen in this part of the world, we have seen a lot of these things that because before the pronouncement of corporate tax and VAT and all, we all know that a lot of things were very common between the individual and the company. Lot of time, or earlier actually, there was things where company could not own certain things, so the owner was taking in their own name, but using it for the benefits of the company. So yeah, we is still seeing such kind of things that some real estate is in name of individual. However, he has given for the benefit of the use of the company. In this case, what I can suggest that probably ideally this should get transferred in the company's name. But if it cannot be done, at least a proper disclosure has to be there in the related party transactions that the following assets owned by the individual or the owner or the shareholder is being used. However, these are still not registered in the name of the company. However, risk and rewards relating to this property, building, or whatever it may be, is entirely with the company. So I think remaining questions on the same matter we can take at the end. We can move to the next one then.
Yeah.
Next one, I think we have all come across this issue many times during our audits, and we generally have to be very careful. Before we discuss this mistake, just want to give a brief about what is current and non-current classification in accordance with IS1. So what IS1 says that entity must normally present a classified statement of financial position separating current and non-current assets and liabilities, unless presentation based on liquidity provides information that is reliable. In either case, if an asset category combines amounts that will be received or settled after 12 months with the assets that will be received within 12 months, no disclosure is required that separates the longer term amounts from the 12-month amounts. So basically what the standard asks you to separate current assets from the non-current assets. What are the current assets in generally? Current assets are assets that are expected to be realized in the entity's normal operating cycle. Now, company to company or industry to industry, the normal operating cycle can differ. Sometimes the normal operating cycles is 3 months, like for trading entities, but sometimes it can be more than 3 months. So in that case, you need to see the normal operating cycle, and accordingly, you need to see whether the asset will be current or non-current. Current assets should also be held primarily for purpose of trading. They are expected to be realized within 12 months after the reporting period, and cash and cash equivalents are generally current assets unless these are restricted. If these are restricted, it cannot be withdrawn, then we need to see whether it will be current or non-current. And whatever assets are current assets, all other will be non-current assets. So first you need to see whether assets are current. If not, then you need to classify it as a non-current. Similarly, current liabilities are those which are expected to be settled within the entity's normal operating cycle, held for purpose of trading, due to be settled within 12 months, and for which entity does not have right at the end of reporting period to defer settlement beyond 12 months. And all other liabilities which are not current are non-current. So coming back to the mistake, as we know, IS1 requires us to show both current assets, non-current assets, and liabilities separately from current assets, and non-current assets and liabilities separately from current assets and liabilities. It seems very easy, but then many times why most of the companies are getting it wrong. Well, while it's quite simple to distinguish current debt from long-term debt or current assets like trade receivables from non-current assets like long-term investments, there are some items not apparent at the first moment. So when you look at them, just for an example, a company might take some debt repayable installments like bank loan or even lease commitments. Or a company might face some liabilities for removing the assets and restoring the site after the end of its useful life. In all these examples, a company has one liability in fact. However, as a part of this liability is due within 12 months after the reporting period, and another part is due beyond this 12 months. And therefore, this liability should be split into current and non-current portion. Many times during our audit or during our accounting, we see that end of service indemnity generally we classify as non-current liabilities. However, on the reporting date, if we know that out of this sum has to be settled within 12 months, we should definitely classify it as a current liability. Other examples of this is asset removal obligation or liabilities for decommissioning, finance lease liabilities. These also should be bifurcated into current and non-current. Whatever is due within next 12 months should be current liabilities, and whatever is due after 12 months should be non-current liabilities. Similarly, banks and other loans, we need to read the agreements, see when the repayment is due. Accordingly, we should classify this. However, one thing which we have to know, since we are in now tax jurisdiction, that deferred tax asset or deferred tax liabilities are always disclosed as non-current items. Do we have any observations, any inputs on this?
I think there's a question from Lakshmi Somakumar. I'm just unmuting if you can ask your question.
Yeah.
Yes, sir, in the scenario which you mentioned, so
Yeah.
I actually have a doubt there in basically when we look at finance lease receivable or lease liability balances, when we talk about the 12 months, what is payable within 12 months bucket, would you consider the after carving out the interest component or before carving out the interest component? So assuming
See, the carrying value of the liability doesn't
is
include
yeah,
interest because it's a
carrying
present
value of
value.
liability. No, I'm actually my question is more from a finance lease receivable perspective,
Receivables.
which
Okay.
yeah. So I'm leasing something. Okay, so I have a finance lease receivable sitting in my books. Okay,
Right.
and it has both. I mean, for over the next 12 months, I will get some portion which will be maybe the EMI or something which will include both interest and the principal component. So
Right.
the short term portion, should it be, I mean, I could not find any guidance where how that portion is specifically
We have to see the specific agreement, but looking at what you are
no.
saying, if your receivable is accounted for and
So
receivable is
basically,
accounted for both principal and interest which you will get, then definitely the entire amount should be shown as current.
no, maybe I'll just clarify the question. So, assuming I have a finance lease receivable sitting in my books, okay,
Okay.
and we of that I'm going to get every month probably one installment. That installment will have both lease component and non-lease component. Rather, one portion towards the principal, one portion towards the interest. So, the practice.
Voice is gone.
Yeah, we cannot hear you, madam. Maybe we'll
Hello?
take it later. Yeah.
Yeah. Can you hear me now?
Yes, now. Yeah.
Yeah. So basically, my question is for in the current portion, do you include, suppose you're going to have 100,000 as the rent which is receivable in the next 12 months. So will you consider that 100,000 into 12 in the current portion, or will we consider only the principal portion?
I
And
will ask you a few questions and I think you will get your answer. What is
yeah,
your carrying value of that receivable? Does it include interest? I don't think so.
it
It will
will not.
include
It
interest.
will not include interest.
It will
No.
include only the present value of the receivables which you are going to get. So
Correct.
let's say you have 1,000 receivable, out of which 100 you are showing as current and 900 you are showing as non-current. However, against that 100, probably you'll receive 120, right? Because
Correct.
you'll receive
Correct.
the interest also. So, but in your books, it will be 100 only. So when you receive 120, you will set off your receivables 100 and 20 you will book as a finance income.
Correct. So in the
So
current
100 only
portion,
has to, only the present value of receivables have to be booked as current, which you are going to get in the next 12 months.
Yeah, fair enough. There is
So probably you'll have an amortization schedule that each month how much you will
yes.
receive, and out of which how much you will book the income, how much you will adjust the principal.
Yes, I got your perspective. Yes, okay.
Yeah.
Because I had a different perspective wherein not different basically. The way we were looking at it is that for the next 12 months, ideally there should not be any interest which will be there. So we used to take an assumption that that full 100 we will, whatever is the lease receivable, we will put it as current.
No, I don't
So,
think so. Interest will be there also on what you are getting next year.
fair
Yeah,
That
enough.
you will
I
have
get
to,
your
yeah.
point. Yeah, I get your point. Thank you.
thank you.
Welcome.
Anish, we have one question in the chat also. Should we take it up or should we move
Yeah,
ahead?
please.
Uh, if in some countries cash balance is trapped due to foreign currency or forex issues in that country, as a result, the company cannot upstream this cash
The
balance
cash
to
balance to the
holding.
holding company. Can this cash be called as
Yeah,
restricted cash?
yeah,
I would say rather to call it restricted, first of all, we need to see the ECL provision, whether ECL is required or not.
yeah,
Whether are we going to get it at some time? This is a temporary restriction, or this is a like very doubtful that this amount will be done.
yeah.
So
And
restricted in the sense whether it's imposed by the country or it's imposed by your own circumstances. But definitely, this is a tricky question. I don't know why this cash cannot be brought. Maybe because the country's economic cannot allow you to bring it. Is he online?
This is Jitesh. Yes, sir. This is
Yes,
my
Jitesh.
question. Recently we had this issue in Egypt, and we always have this issue in Tunisia and these countries where there are very limited FX reserves, so we cannot extract these funds and bring back to the holding company. So
But
currently we
this,
are
first of
classifying
all,
this,
this cash is lying in your subsidiary company, right?
yes, subsidiary companies.
So the classification will not determine whether you can bring it to holding. What about the subsidiary company's classification? They have to classify first.
Those
And
are
you
into
need to
current assets.
see, sorry?
Those are into current assets of the company in the
Yeah.
subsidiary local book.
So if it's in the current assets of the subsidiaries, there you are not saying it's a restricted. How can it be restricted for holding company? Holding company
Okay,
will probably get the dividends. They will not get the cash balance of the subsidiary.
okay, okay, got you.
Yeah.
Yeah, thanks.
I think
Yes.
Nasir sir also has got one question, it seems.
Oh my God. No, no. Okay. Take it.
I'm unmuting you, sir, if you can ask your question.
No, I think you continue because I think the time is constrained.
Done. Okay. Okay, sir. All right.
This.
Thank you, Prabdeep, for saving me.
Nasir ji, I think.
Okay. Very important topic. Failing to report transactions between the related parties. And related party itself can have for one full session. However, we all know that how important now, particularly now from this year onwards, is to disclose the related party transactions appropriately. And particularly those who are tax experts, they would have seen a lot of transfer pricing adjustments, either in the tax return or in the financials. From my own experience, I can say that related parties are the most popular, particularly in this part of the geographies, where I think in some entities, most of the transactions are routed through either subsidiaries or to the entities under common controls. And transaction between them sometimes are so sensitive that the standard setters earlier have to bring a separate accounting standard for this. And particularly if we see the submissions or findings of the regulators in this part of the world when they audit the where they audit the auditors, they generally pick related party transactions. It's their favorite. And still, we can see that a lot of incorrect related party disclosures are one of the top IFRS mistakes. Do we know why companies forget who related parties are? And sometimes because of this, they don't disclose it. Many times we see that we need to disclose key management personal remuneration, yet we forgot to disclose their bonuses, which are more than sometimes the salaries. So how can we avoid these kind of mistakes? We, at the beginning of the audits or beginning of our accounting, we should prepare the entire list of related parties. And that should also include list of all the key management personnel. And key management personnel sometimes are those who can participate in the operating and financial decision making of the company. So definitely we should ensure that we disclose all kinds of compensation to key management, including share-based payments, bonuses, sometimes severance payments, and sometimes end of service indemnity and other employee benefits. I'm just restricting to the key management personnel because other transactions more or less generally are disclosed in the financial statements, but key management personnel particularly is important because in most of the tax return, this will now be claimed as a deduction. So their disclosure in the financial statements are very important now. But apart from that, the other related party transactions, we all know that we need to disclose, and particularly relationship-wise, whether are there with subsidiaries, they are with associates, they are with joint venture parties, or these are with other affiliates. So many times I have seen in the financial, we just have big line items of the related party transaction, but relationship is not mentioned. So, but the IS 24 clearly mentioned that relationship wise, we need to mention the balances as well as transaction. So this should be kept in mind. Any observation which you have made in the related party transactions, we can discuss.
There was a comment in the chat box. Dividends also should be disclosed. Is what they're asking, I think.
Yes, dividends definitely is a related party transaction because dividends are disclosed to the shareholders, and shareholders definitely are related parties. Dividends, sometimes people don't disclose in related party transaction because separately they are disclosed in the statement of changes in equity. And with that, there's a relevant note also because IS1 also asks you to give the disclosure of dividends and particularly dividend per share, at how much dividend per share you are giving. And when it is declared, when it's authorized, and dividend in particularly, if it is authorized after the year end, this will not be accounted as a dividend paid or payable, but it will be only disclosed as a proposed dividends.
Yes, so there's a question from Dilip Jainji. Dilip Jainji, yeah, please go ahead.
Good evening, everyone. I would want to add 2 points. One is about this disclosure of transactions where the transaction value should be disclosed inclusive of the tax amount. At times, people say the tax is to be excluded, but here it's not about the tax, it's about the transaction. And paying the tax to the related party or receiving it is also a transaction. So the
Being
value
tax
of
or
the
cash?
No, I'm saying the tax amount. Say purchase and sales, it is inclusive of the tax, say VAT or any other tax on the sale or purchase.
Right.
The total value should be considered as a transaction, not the purchase price excluding the tax.
Right.
That is one observation that I had. And
Okay.
another is, the disclosures of related party transactions and balances at times, the mistakes are intentional in the sense that the owners do not want to disclose. That's historically the practice in this region, that they do not want to disclose, particularly the remunerations. However, the current scenario now requires all these things to be disclosed in details, and then the transfer pricing also hits in now. So all these have to
Right.
be at arm's length. So that is something that we now need to be very careful and explain
You are
and
right. In
educate the
fact,
client.
earlier, a lot of companies, they were paying not remuneration, but they were paying management fees.
Yes.
And now they have changed now to management compensation or management remuneration because they want to take tax benefit of it. And this probably have started from 2022, 2023 onwards because they don't want to suddenly come and change the way they were giving the payments to the management or the key management personnel. So I'm sure many of us would have seen suddenly the salaries to the owner, salaries to the managing directors, chairman, all these have coming now.
Yeah, even your point earlier on the, the question that was asked about assets owned by the owner and all the rewards and benefits of the company. Now, even in that, now we need to be more careful because now the owners are taking back those assets and probably leasing out to the company in a way of a lease transaction. So company now starts incurring an expenditure on leasing, and that has a tax impact now. And then as an individual, the income that is earned from that lease may at times in certain cases be non-taxable for that individual. So we need to
But
consider
again, I
that as
think
well, how it has to be, it will be seen by the authorities. Is it a tax
exactly.
planning or is it avoidance activity? That also we have to be very careful, and probably we'll
Right.
have to involve the tax expert in assessing these cases.
Yeah, you have a valid point, but then again, authorities will also not keep quiet. If this leasing activity becomes the business, probably they will
Yes.
then take this into purview also. But yeah, and plus also we as an auditor or professionals also have to see if the company is doing these leasing activities, then probably we have to assess in accordance with IFRS 16 as well, right to use,
Yeah.
and then bring that lease into the books.
Yes.
So
Thank you.
good observations. Thank you.
We have one more also from Vishalji. Should we take it, Anishji?
Yeah.
Yeah, Vishalji. Yeah, please go ahead, sir.
Yeah, hi, good evening,
I
Anish.
hope everyone is benefiting from these question and answers because otherwise it's all theory.
Hi, good evening, Anish bhai.
Good evening.
Anish bhai, just one question relating to related party. Whether our day-to-day funding or advance transactions also needs to be reported. I had mentioned in the while.
You are Vishal Talreja and your question is there in the slide at the end.
Yeah, okay then.
We will take at that time.
Okay, thank you.
And we have some in the chat box also. Should we take them up, one or two?
Yeah, quickly we can take.
From
Shareholders, partners, capital over and above share capital of say 80 to be presented under equity and reserves, or it will be a liability. This question is quite similar to the question which has been raised by Mr. Janak Panjwani.
Yeah.
So we can take at the end.
Yeah. There is one more. If a person is a shareholder of entity A and the same person is manager in entity B as per trade license, but not a shareholder in entity B and not included in the day-to-day transactions, will entity A and entity B considered as related parties?
If that manager is controlling both the entities, then probably we have to look into it.
Yeah.
Or maybe if the entity in which he is the owner is controlling the entity B in which he is the manager, then it is indirectly he is controlling. So each
Yeah, so
circumstance
that's
we will
what
have
saying.
to.
Directly or indirectly, the standard says.
Yes.
So we need to
Yes.
assess whether control is there or an influence is there, and accordingly we can take a decision. So this requires understanding of the agreements.
There's one more.
I think let's move to the next
Yeah,
because
let's
at
move
the
on.
end we'll
Yeah.
take more questions.
More questions. Yeah, right.
This again is a very common thing, and we have seen in all the financials or most of the financials that sometimes the useful life is assessed, but the asset is still being used, but the carrying value is zero. So now with the tax, it also becomes very important because this is probably the biggest mistake which is related to the property, plant, equipment, and many companies do that. I'll just tell you what's going on in the marketplace, that when a company buys some piece of property, plant, and equipment, management has to decide that how long the company is going to use that asset, because depreciation is over the useful life of the asset. And useful life is a big judgment or big an estimate based on what management thinks that the company needs are going to be from that asset. And sometimes these estimates or judgments prove to be grossly wrong. If you spot the following situation in your company's account, probably then the useful lives are almost for sure incorrectly determined or estimated. First example, you have too many items of PP that are still being used but have been fully depreciated. And as a result, they are carried at nil. And for such kind of assets, even the IS recommend that we should give a disclosure that for that so much amount of assets are fully depreciated but are still in use. Sometimes company realize too big profits or losses on sale of property, plant, and equipment. If the asset is used for its full useful life and after that you are selling, ideally big profit should not come. But if big profit is coming, probably we have not estimated the useful life properly. Companies building are depreciated while their fair value goes up in effect. So basically, sometimes we don't follow the revaluation model also, which I think a lot of people are now looking at the deduction which tax can give because of revaluation surplus.
Hello?
How we can avoid this mistake that IS
Hello?
16.
I'll just mute all and then unmute you.
Okay.
Hello?
Please unmute yourself, Aniji. Aniji, you're on mute. You have to unmute yourself.
Oh,
Yeah. Now it
I
is.
was not audible. Okay.
Yeah, now it is fine.
So how we can avoid this mistake is that by reviewing and revisiting PP's estimated useful life at the end of each reporting period. As a part of annual review, we should look at the register of property, plant, and equipment and search for the items which are still in use but at net value and see if we want to re-estimate their useful life. Anyways, once it is zero, you cannot, even if you re-estimate the useful life, but there's nothing to be amortized. But for future, this can be a reference. Have anyone come across such situations for the property, plant, and equipment useful life? Do we have any questions on this?
No, I mean, as you rightly pointed out, what is the point in re-estimate? The life is over and the book value.
Yeah, but for the future assets, we can definitely take this into account and have a realistic useful life so that we can have proper depreciation charge.
Yeah, we do this for running assets, of course. If still there is a NBV left, then of course there is a point in doing it.
Sure. At the end of the day, it's an estimate. Estimates cannot be 100% correct. And that's the reason IS1 also asks you to disclose the key estimation or the critical judgments when you apply the accounting policies.
We do that segment-wise, like for example, land, buildings and infrastructure. This is the range of the depreciation. But you mentioned about some disclosure requirement for fully depreciated assets. Is it recorded in like these many assets fully depreciated? Like how do you?
Generally says that like it will read like this: at 31st December 2024, assets with the cost of this much are fully depreciated. You can give comparatives also. However, they are still in use. So that a reader can say that, oh, this much assets are still in use, and that's why it's carried in both cost as well as accumulated depreciation.
Yeah, okay. On a flip scenario, you can also revalue, put some value back into the books to
Sorry,
improve the
come
balance
again?
sheet. On a flip scenario, we can also revalue and put some values in the balance sheet.
Then you have to follow the revalue model, and that you cannot do for a single asset. You have to do for the entire block of assets or category of assets.
You can't do it for.
No, you cannot just cannot pick and choose and do for one asset. Okay, let's move to the next then. I think this must also be very close to all our accountants. I think in a day-to-day life, we come across such situations, whether a particular change is an accounting policy change or it's an accounting estimate. it's crucial to determine correctly whether it's a change in accounting policy or change in accounting estimate, because again, your accounting will depend. If there is a change in accounting policy, we all know we have to do retrospective adjustments. However, if a change in accounting estimates, the changes will be prospective. Just to give a brief background on this, that it's really crucial to determine correctly whether you think this is a change in accounting policy or change in accounting estimate. And why is this so? The reason is that the accounting treatment of two is totally different, as we discussed. And if we don't deal it properly, maybe our IFRS financial statements might contain serious errors. If you apply changes in accounting policy retrospectively, you have to go back. And it means you apply the new accounting policy as if it had always been used, so you need to adjust your opening retained earnings. As opposed to that, if you apply changes in accounting estimates prospectively, you don't have to go back. It means you calculate the amount of change and include in the profit and loss in the current period, or both in the current and future periods, depending on how it will change the estimates for the future as well. Many companies mess things up and just don't know whether they deal with an accounting estimate or accounting policy. As a result, things are incorrectly booked either in equity instead of P&L or vice versa. How to avoid this mistake when dealing with changes in accounting estimates or policy? Just think about what you are doing if you change one of the following. Is it a measurement basis change? For example, from FIFO to weighted average, or a presentation criteria change? For example, deciding to offset amounts of assets and liabilities where permitted, or recognition criteria itself. For example, changing the materiality levels for recognizing non-current assets. Then you change an accounting policy and you need to recognize it retrospectively. For all the other cases, let's say changing the useful life of PPE or discount rates for calculating value in use, these all probably will fall under the change in accounting estimate, and then you need to recognize it prospectively. Any observation you have faced on this which you would like to share with the audience?
Yeah, within the financial year, let's say we do this in July. Can we do it from 1st January?
Sorry, come again.
Let's say we are doing this exercise in July. So within the financial year, we can do like retrospective, like from January. I mean, if calendar is the financial year.
What? Change in accounting policy or change in accounting estimates?
Estimate. I'm revising the life of the asset.
Yeah, estimates you need to revise when and where you feel that now I have a realistic information, reliable information, and I should change my estimates. And from then onwards, you will change your accounting.
Yeah, I mean, I completed the exercise in July, but can I play within the financial year? That's my question. I mean, what do you mean by retrospective? Is it like you cannot open the previous?
The change in accounting estimates is prospectively from now onwards. Retrospectively means if my accounting policy would have been from the beginning itself, then what would have been the accounting impact on that? So, and whatever is the impact of the previous years, probably either you will take in those years, or if it's impracticable to identify when it was there, then you have to adjust your opening retained earnings.
No, within the financial year.
Change in accounting policy.
Within the financial year.
Change in accounting estimates will be during the financial year only.
I think the question was like if there is any change in the accounting estimate in the middle of the year, should I start doing that correction from the middle?
Let's say if you've identified in July, he has to account from July onwards based on that estimate.
Yeah.
Got it. Thank you.
Yeah. Should we move ahead?
There is one in the chat box.
Mm-hmm.
If one has realistic information on useful life of asset, are they required to revalue the asset in financial statements, or disclosure is enough?
If one has realistic information on useful life of asset, when?
Yeah.
Useful life of asset when they have realistic information. Nasir bhai, are you there?
Nasir ji,
Yes. Let us say if the asset is fully depreciated, but
Okay.
let us say in case of real estate, we know the property is fully depreciated, but the like market value, is easy to know the market value. And uh, if the auditor comes to know the market value, let us say even 50% of the original cost, though in the books it is zero. So auditor just has to give a disclosure, or uh, uh, the company has to do the revaluation. Is it as per IFRS what is required? Because we know that the asset value, let us say 1 million, but it is zero in the books. We have a realistic information that
I
the
know. When you
value.
talk about real estate, first we need to identify whether it's a property, plant, and equipment for your owner occupied business, or is it an investment property? Like whether you have given it for rentals or for capital appreciation you have kept.
Yeah, if it
And
is PPE, mostly if it, the question will be in the case of PPE only because it is fully depreciated
even
uh,
in investment property, if you opt for the cost method,
cost
there
method.
also it can be zero.
Yeah, correct. So
Yeah.
what is the requirement as per IFRS?
No, IFRS IS 16 gives you choice. And if you think that and revaluation is something which can be opted after you have initially recognized at cost and depreciated. But you can go to revaluation model anytime if you think that will provide more realistic or reliable information to the financial statements. But as I mentioned, it has to be applied on the entire asset category. You cannot just do it on a one asset. However, if you have, let's say, multiple real estate and all are depreciated or all are, some are fully depreciated, some are partially depreciated. If you want to apply a revaluation model, you have to apply on all those assets.
But then it may not give true and fair view, correct? Because some of them have low value, some of them are high value. So
If it's no value,
substance.
fair value should be zero.
No, let us say I have four assets. One has high value, one has low value. And if I have to revalue the entire thing, all the assets, will
It
it?
can go either way depending on the
So
fair
it is
value it comes
optional.
out.
You're saying it is optional to go back to
It is
revaluation.
optional, but general tendency is one you go to revaluation model, going back to cost is not possible.
Hmm.
Because once fair value is available, it should be available forever. This is generally the intention of the standards. And then every year, then you have to do fair valuation, or every couple of years or 3 years, that you can decide that the standard gives you leeway.
So
You
here
have to
auditor's
decide.
responsibility is just to give disclosure in the financial statements that the assets still have the useful life.
Yeah, that is also recommended. It's not mandatory.
Mandate. Ah, okay.
But generally, what we see that cost is, let's say, 20 million. Depreciation is 19 million.
Okay.
So carrying value is 1 million only.
Yes.
But all the assets are still in use. So
Yeah,
that's why they
it
give
can
the
be
reader.
zero
Because
also.
generally, if you see that from 1 million, how the company is operating. That's the reason this disclosure is given, that asset is still worth of 15 million are fully depreciated, but is still in use.
Yeah, but I just wanted to know, is it mandatory? Is the responsibility of the auditor as per IFRS, or
No,
it
it's
is
recommended. Recommended to
recommended?
give this disclosure.
Okay, okay, okay.
Yeah.
Thank you. Thank you.
Let us move.
yeah.
I think the agenda one, agenda two is kind of similar. What mistakes we can avoid can become the best practices. So let's move to some of the best practices which we should follow. And the first one is the offsetting. And offsetting, or you may also call it netting. It involves presenting items that would otherwise be shown separately as a single net amount. IFRS standards permit or require offsetting only in specific situation, and inappropriate offsetting can be misleading to the users of the accounts. So when you do the offsetting in the financial statement, and when you think it is right to offset, you should disclose material accounting policy information relating to offsetting, ensuring that all relevant aspects of any offsetting conditions are included. You should also disclose significant judgments made in relation to that offsetting of income and expenses or assets and liabilities or cash inflows and cash outflows. One of the examples that when you present cash inflows and outflows within investing and financing activities on gross basis in the cash flow statement, you should ideally do that, except in limited cases where netting is either required or permitted. Sometimes, many times, or sometimes, or actually most of the times, we see that we consider to exclude overdrafts from cash and cash equivalents in the cash flow statements when the overdraft remains overdrawn over several reporting periods. Why is that so? Because if you consider overdraft as a part of cash and cash equivalents, you will not show the liabilities in true form. Because if you have taken overdraft and it always on the negative side, it doesn't fluctuate to the positive side ever, then probably it's more of a liability than it's a temporary cash and cash equivalents. As a general principle of IFRS, offsetting is generally prohibited, except where expressly required or permitted by some accounting standards. Is it okay if we move to next, or do we have?
There is one question in the chat box. When hedging of gold and silver commodity for future purchase and sales, trade can be net out for disclosures of income. When hedging of gold and silver commodity for future purchase and sales, trade can be net out for disclosure of income.
Does it
Sanjay ji,
need
if you want to elaborate.
Is
Sanjay
that
ji,
gentleman or?
Sanjay ji, do you want to elaborate that question a bit?
Sanjay Mehta here.
Yes.
See, many bullion traders are doing hedging of gold and silver commodity in the commodity exchange, okay? And there is a purchase and sales transaction is happening. So really trade is closed after, regular purchase and sales transactions, and they generate the income, okay? So whether the netting is allowed in that or purchase and sales should be shown separately, where the physical quantity is.
First of all, this is, I believe, is only a derivative contract, right?
Yeah.
It's a derivative contract, and probably mark to market value you will record in your books.
Yeah.
The next question which you have to answer is whether the legal right to settle is there or not. Like, do you have to settle net or do you have to settle them separately?
In some cases, there will be
Because one hedge may be asset, other hedge may be liability.
See, many times it might be settled if required. The delivery is possible. Delivery can happen, and then many times they are generally settling in the income or loss.
No, but what your agreement says with that hedging institute. So you need to go through the agreement and see if the legal right to settlement is there or not. If the legal right is not there to settle, okay, actually you must be setting it net, but the legal right is not there, then you cannot do that offsetting.
I didn't get. If delivery is possible, then I have to show the purchase and sales separately.
I'm not talking of delivery. I'm saying settlement of that contract.
Yeah.
Now, to take delivery or not, that is your business decision. But how you will settle that contract? Let's say gold contract, you have positive value, whereas silver contract, you have a negative value.
No, I'm not setting up gold and silver transaction. Let's say gold separately. Let's say only gold transaction is there.
Okay.
Not a netting out between gold and sales. So gold purchases happen, gold sales is happen, and there is a continuous purchase and sales. So can I net out purchase and sales, or I have to disclose separately purchase and sales? So whether I can show directly
you have
net
to see with the agreement that ultimately you have to settle it at a net value, or you have to settle purchase separately and sale separately. So legal right is there or not to settle. If legal right is there and it's with the same party, then probably my view will be that you can offset.
Okay.
Yeah.
Fine. I put another questions also, but that you told me take it separately. So we'll discuss.
Yeah.
Thank you. Thank you, Anis.
Welcome. Let's go to the next one, judgment and estimates. We all know from long time now, we have to disclose as a separate note in the financials that what are the significant judgments and estimates which management has to take. Because disclosing this significant judgment, which can have a material impact on the carrying value of the assets and liabilities, or significant estimates, or what we call it estimation uncertainty values, this can have impact on what are the amounts which will materialize in next 12 months. These two aspects become very important, particularly with the significant account balances. And a reader, after reading this, can take a view that what is going to be the future, particularly for these assets, liabilities, or income and expenses. So when it comes to the significant estimates, please clearly specify which estimates have a significant risk of material adjustments to the carrying amount of assets and liabilities in the next financial year. And generally, estimates we have to assess only for the 12 months. Also, quantify the specific amount at risk of material adjustments. Provide sufficient granularity in description of assumptions or uncertainties to enable user to understand that from where management is coming from. What are the management's most difficult, subjective, or complex judgments which involves these estimates? This is in order to provide meaningful results, and for that probably we can also provide some sensitivities. So we record certain transactions based on estimates. However, to make it more understandable, we can always give sensitivity. Just for an example, that we do some fair valuation of assets or investment properties. Maybe we can disclose some percentage that if fair value is less than 5% or more than 5%, what could have been the impact? I'm just giving you an example. Similarly, significant judgments, and generally they should be separately identified, because this will not be particularly related to the estimation uncertainty, but it will be important in applying the accounting policies. So we should give detailed description of the specific material judgments made by the directors in applying their accounting policies. One such example which comes in my mind is, let's say, if someone is in food business, whether it will be good to apply weighted average for the valuation of inventory, or it will be good to apply FIFO. So this is kind of judgment which management is take based on the understanding of their business. And therefore, if it is different from others, it should be disclosed as a significant judgment. Similarly, estimates example, if I can give, is what we have discussed in past, useful life of assets, useful life of property, plant, equipment. That's an estimate. And if someone is capital intensive, and such estimates can change the value of the assets and liabilities, that should appropriately be discussed, that what was the management thought process of having particularly useful life of particular asset. Any questions on this? Or we can go ahead then.
Yeah, I think we can go ahead.
Yeah. This is again a very important topic, and particularly in these recent times, particularly after COVID. We all know that the stakeholders are increasingly concerned about the impact of volatilities on entities' ability to continue as going concern, given the significant economic uncertainties, and particularly when there is a reduction in entities' revenue, profitability, and also the liquidity. This has increased the importance of going concern assessment and the related disclosures. This particular aspect is also very minutely, closely looked by the authorities when they come for the practice reviews or the peer reviews. So as an auditor, we have to challenge the management, particularly when there are going concern indicators. We need to challenge the management and probably ask them to describe in very detail in the notes to the accounts. And what can be described is that they should include sufficient qualitative and quantitative information to enable reader to fully understand the assessment. Because first the management has to do the assessment. They have to understand that how, if the entity is in losses, how they can recoup those losses, how it can come into profit back. This should require detailed company-specific information to be provided. Forecasted P&L for next 3 to 5 years should be there with a proper basis. This disclosures or estimation can also include how much is the drawn facility, how much is the undrawn facility, which can be used for futures, and whether we can rely upon such facilities, whether the covenants are met at the reporting date, whether these facilities will be taken back if covenants are not met. All these aspects we should assess first management and then as professionals as auditors. Use assumptions which are clearly consistent with those used in other forward-looking areas of financial statements such as impairment testing. Many times we see the management prepares the estimations, next 5 years cash flow projections they prepare. They take a certain growth. However, if you see that growth has never been achieved, so then we need to challenge the management that how you will get this kind of growth when in the past you have not got, and even in previous year you have said same thing, but you have not able to met that. So we as an professional should challenge those. Clearly explain the inputs and assumptions used in those forecast scenarios, and that should include both quantitative as well as qualitative information. As previously mentioned, also management should give sensitivity analysis, like say if growth is changed from 1%, let's say we have taken 3%, what if it only 2.5% or 3.5% will grow? What will be the impact? If the cost of capital is taken at X percentage, what will happen if it's X minus plus 0.1%? All this sensitivity can be given to make reader understand that the entity have enough headroom and going concern assumption is still appropriate. Clearly identify any material uncertainties related to events or conditions which may cast significant doubt on an entity's ability to continue as going concern, and then highlight the significant judgments. This is particularly more important because if a material uncertainty is there, you as an auditor need to ultimately convince yourself that the entity will still be going concern, or there will be a problem in the going concern, taking going concern assumption. In that case, you also have to modify your audit opinion. Some cases you have to give qualification of material uncertainty. In some cases, you have to just live with the emphasis of matter. If there is enough working to prove going concern, or there is enough support and caliber and the credit worthiness of the shareholders to provide the support. So all these things should be looked upon when you decide on the going concern assumption. Any questions?
No, I think we do not have any in the
No?
charge list. Yeah.
Quickly we'll go through, we have time, right?
Yeah,
quickly we'll go through some of the key items which I feel that every professional should look into when preparing the financial or reviewing the financial statements. So reference is given as IS1 para 117. An entity is required to disclose their application of material accounting policies. Common errors are that accounting policies or boilerplates are sometimes missing for material balances. Example, if particularly these accounting policies are new during the year. Like a lot of time when we see when IFRS 16 came into this, still some of the management or some of the companies were carrying the old policies for the leases. We as a professionals have a duty to guide them so that the financial statements carries the correct policies. Some of the examples you can see on the right-hand side of the column is the revenue accounting policy sufficiently specific to the business? That is, can the user of financial statement tell what the entity's business is from the revenue accounting policy? Sometimes we see that there is a revenue from certain activity, however the accounting policy is missing. So we need to be carefully for each significant revenue stream, accounting policy should be disclosed. Does the entity explain the policy for each type of disaggregated revenue stream? Has the entity stepped back and checked the completeness of the accounting policies to the material balances? Because if you see now the heading has also changed. It has changed from significant accounting policy to material accounting policy. And therefore, it becomes our duty that all material balances should have the accounting policies. Are there accounting policy disclosed which are not relevant to the transaction and the balances in accounts which could be removed? Like sometimes we don't have borrowing costs, but still we carry the accounting policy of borrowing costs. Have the accounting policy been updated for changes in standard? As I mentioned, IFRS 16, when it came, we should have the new lease accounting policy rather than the old one, like operating and finance leases. Common mistakes, which lot of financial still uses, is particularly using terminology from IS 39. Still, we can see some financial which are available for sale, held to maturity investments. However, these terms are no more in IFRS 9. Should move ahead.
I think so, yeah. We have another 40
IS
minutes to
1,
go anyways, yeah.
IS 1 para 48 to 40D. And this also, I think, a lot of us would have seen when there is a restatement of prior year, either error or change in accounting policy or reclassification of balances. An entity shall present a third statement of financial position as at the beginning of the preceding period, in addition to the minimum comparative financial statements required, if it applies an accounting policy retrospectively. This is number one. Number two, makes a retrospective restatement items in its financial statement or reclassifies items in the financial statements. In all these three things, it becomes important to give the third balance sheet, and which will be nothing but the beginning of the comparative period. So let's say I'm preparing financial of 31st December 2024. My comparative is 31st December 2023. So if there is a restatement in the financial statement because of these three things, either of these three things, there will be third balance sheet, which will be of 1st January 2023. So we as an auditor, whenever we see that if there is an accounting policy change adopted because it will impact my old financials, or if there is a restatement of items because of an error or because of a prior period error, or if there is a reclassification between the various account balances, between the assets and liabilities, then also it tantamounts to presenting third balance sheet at the beginning of the preceding period. I'm sure many of us would have gone through these things and would have seen a lot of financial being restated.
I have a question.
Yes, sir.
See, like with now tax coming and most of the entities having the first year of, we can say, financials being prepared as per IFRS, and there will be many instances wherein the previous year financials would not be complying to the IFRS, and
Right.
the accounting policy change, which may see, and so
Accounting policy, yeah. Okay, go ahead, please.
yeah, like see, if you talked about revenue, and maybe it may be that the revenue itself was not being recognized in the right way, and so if we have to let's say in kind of construction contracts which are complicated a bit, and there may be an input there, the policy may change in terms of, okay, the revenue might not have been recognized in the right way. So how does this impact? Like, we will have to restate the previous year financials, and maybe for a comparative year, and then there may be a tax it may be coming under the tax authority purview as well, because the profit numbers may also change accordingly for previous year.
Yeah. Deepak, right?
Yes.
Deepak, definitely. See, first, I presume that the financials were under IFRS last year also. This is not, because generally in this part of the world, we have IFRS only. So I presume the last year financial were also under IFRS. However, in this year, particularly when you looked at the tax impact assessments and all those things, you thought that this revenue stream should have been accounted for in a different manner last year itself. And definitely then it will probably, it's a prior period error. You should have accounted for something which should have been accounted in a different manner. So definitely you will restate and I'm assuming that the impact will go to last year or the previous years.
Yes.
So in that case, it's a fit case to provide the restatement. And definitely, when you complete this year financials, you will have comparative, and on top of that, it will be mentioned as restated. And then the third financial will also come, because probably the impact will also go into that. So the third balance sheet will also have to be prepared, and which will be the opening of your comparative, and that will also be restated.
Okay. Thank you.
But restatement, when it will be seen in the heading, I don't think, I'm not the right person to think that what tax authority will see. But your financials are compliant with IFRS, and if they are saying IFRS financials are fit, then there should not be an issue.
Yeah. Okay. Clear. Thank you.
Yeah. We can move, Balram.
Yes, sir. Yeah, we can move ahead.
I think next issue we generally face is item classified as cash and cash equivalents. So we have seen that items classified as cash and equivalent must be short-term, highly liquid investment, and that are readily convertible into cash. And you have to note this in particular, that with an original maturity of no longer than 3 months. Many times we have seen that we have fixed deposits of 3 months or less than 3 months at the reporting date. However, originally they were of 6 months. Just to give an example, I've taken, my year end is December. I've taken some fixed deposit in October beginning for 6 months. Yeah, at December, only 3 months are left. So the standard doesn't say that on reporting date you have to see. You have to see the original maturity date. Since original maturity date was 6 months, so even at the reporting date, you will not show this under the cash and cash equivalents. You still have to show as other assets. Further, cash and cash equivalents must have an insignificant risk to changes in value. So, as a professional and auditor, we always have to ask that are investments classified as cash equivalents limited to those investments which are readily convertible to cash within 3 months of the original maturity date. So this generally does not include items when they have now a remaining maturity of 3 months or less. This is what I've told. The next thing we have seen in most of the financial is regarding the cash pooling arrangements, where the holding company takes cash from all the subsidiaries or give cash to all the subsidiaries which requires the cash, and the cash pool arrangement goes. So while most external cash deposit arrangement will meet this criteria, so if your cash is lying with any external party, then it's a different case. However, if there is an intercompany arrangement with a treasury function, will meet the requirement in limited circumstances. So if you have a cash pool facility and all companies have contributed to that, or all companies have taken out of that, in that case, you need to really look into it, that whether this forms part of the cash and cash equivalents. Why is that so? Because if there is an intercompany arrangement with group treasury function, and these balances are present with the cash and cash equivalent as opposed to receivable, then you always have to see whether there is an insignificant risk of change in value. Because unlike if the cash and cash equivalent is lying with the bank, if it's lying with an entity which also have a risk to get bankrupt or to close down, then you have to evaluate whether you are classifying really as a cash equivalent or it should be classified as something else. But many times I've seen that fixed deposit with a maturity of 12 months, however, with the remaining maturity at year end of 2 months only, people generally classify cash equivalents, but the standard doesn't allow that. Any query on this? Any observations, inputs?
Queries, there are no queries in the box. I think people are clear about it. Maybe that is the reason.
Yeah. Which means this error is not happening.
Yeah, but since we have more questions at the end, we can still take them.
We'll take. Foreign exchanges, differences in cash equivalents. I think it's a simple one, that unrealized gains and losses arising from changes in foreign currency rates are presented separately from cash flows from operating, investing, and financing activities. We have many times seen that we have foreign currency cash balances, bank balances, and we convert at the year end. So generally, the impact of that foreign currency exchange doesn't go in any of the activities in the cash flow, whereas it is present as a separate line item between the opening and closing cash balance. But many times people just include this in one of the activities, which is not correct. Disclosure of fair value hierarchy is particularly important because now a lot of assets are accounted under the fair value. So IFRS 13, this requires disclosure of fair value hierarchy for the inputs to valuation technique used to measure. The use of relevant observation input is maximized and use of relevant unobserved inputs should be minimized. We all know that the fair value hierarchy gives you highest priority to quoted prices, which is unadjusted because these are prevailing in the active markets for the identical assets or liabilities which you own. And the lowest priority is given to unobservable inputs because these are not available in any of the market and people have to derive this based on certain factors. As a professional, while preparing the financial statements or while auditing the financial statement, we always have to assess that has the entity taken a step back to critically assess that how items are classified within the fair value hierarchy. Are there any items in level 1 that are not cash, cash equivalent, listed debt or equity or government bonds, as these are likely to be incorrectly classified in level 1? Because generally the active markets will be for these kind of assets only and not for the others. So if someone is having other assets classified as level 1, we really need to challenge it. Are there investment properties which are recognized as level 2? However, they should be level 3 because sometimes you will not get the fair value in the market and you need to really determine that how you can value these assets. For any items in level 3, have the additional disclosure requirements around sensitivity to changes in inputs have been provided. Because the level 3 assets probably will be valued considering lot of inputs, lot of estimations. So it's always better to give some sensitivity considering the input factors. So it will give a user the good idea that if a particular factor is changed, how much value can go up or down. We have
Anish,
seen lot of, sorry.
sorry to
Yeah,
I have a
please.
question with regard to cash pooling. Actually, if
Okay.
I can go back.
Okay.
We have an arrangement. A subsidiary company is having cash collection. What is happening is the cash is getting pooled in the head office holding company account. At the and this balance is lying. Whenever funding is required, the head office is funding. Whatever the difference is, or you can say, for example, differences of an X amount or 30. I'll quote a number, 10 million, for example. Okay. And at the year end, what we are doing is we are declaring a dividend from the profits of the subsidiary, and not necessarily matching to that whatever is receivable from the cash pooling amount,
Right.
near to that, and the balance is shown as receivable. So is this classification fine?
So you are basically adjusting dividend with the cash pool you have remitted to the head office.
Yes, yes,
You consider dividend as paid, and
yes.
remaining you are showing as your cash and cash equivalents.
No, not cash and cash equivalent. We are classifying it as part of receivable from related party.
Yeah, if it's shown as receivable, no issues. But then receivables, again, you have to do your ECL assessment
ECL
for the
assessment. But
impairment
it's
testing.
from the parent company, right? So normally what is happening is,
Any financial assets have to be ECL. Maybe the probability of default will be 0, but
yeah,
you have to do the assessment.
I have to do the assessment.
I
So
cannot say you how rich your head office is or what is the probability of default. That you have to assess.
okay, okay. But we are
Yeah.
taking a letter of guarantee from them. So I mean, the owner is giving
Letter
a
of guarantee you are taking is fine as a management, I guess, as a management, right?
yeah, yeah.
But as an auditor, I also say whether they have sufficient credit worthiness or the cash to honor that guarantee.
Okay, okay. Okay, and for corporate tax, I mean, will it be an issue because dividend is declared at the year end, but over the period, like, for the full year, we are not charging any interest there.
That you have to do the transfer pricing benchmarking assessment. I think Balram is the right person to talk about that.
Yeah, benchmarking has to be done for that.
Okay. Okay. Okay.
Better you declare as and when you pay, you declare dividend there itself.
No, but the transactions are happening on a daily basis, so
I know.
I cannot go.
I'm
So
just joking.
either I do a declaration every month, at least a
Yeah.
monthly cycle is there.
If you want to save from the transfer pricing point
Yeah.
of view, you should.
So I
Otherwise, you are
declare
reducing
interim
the
dividends
income of
and
the
then
company. You are losing on interest and you are reducing the income.
yeah. I declare a monthly dividend, interim dividend, and final dividend at the year end. Maybe,
Yeah, balancing you can
Yeah.
do.
Yeah. Yeah. Thank you. Thank you, Balram, and thank you.
Okay, no problem. So we are on the property plant allocation exercise or business combination, which sometimes we see that it's not yet finalized at the reporting date. Even the standard gives you 12 months transition period to finalize this. So the common error is not disclosing required information, including estimation uncertainty when a business combination PPA exercise is not yet finalized. And if the purchase price allocation is not finalized, the company should consider whether there is a significant estimate to disclose in terms of how things might change when the purchase price allocation is finalized. Will there be any items which should be disclosed because they will materialize? Like if you have still 6 months, 8 months, 12, 10 months, will there be any items which will materialize in a different manner? So you should always ask the question, is there a business combination where the purchase price is not finalized before the financial statement are signed? If so, has this fact been correctly disclosed, including any estimation or judgments used in current financial statement? Are there contingent assets, contingent liabilities, which can change your property plan and exercise allocation exercise? So you should always consider that. Moving to and this particularly disclosure becomes more important now. Earlier, text was not there, so this we couldn't have seen. But and we'll at the end of that we will also see we have Balram has helped me in extracting. We have taken from two of the published accounts their tax disclosure, in particular related to current tax as well as deferred tax, and we'll go through them so that people can see that how these companies are doing the disclosure relating to the current tax as well as deferred tax. For now, a numerical reconciliation between the tax expense and statutory profit is required. This reconciliation should exclude temporary timing difference because these will already be accounted for as deferred tax asset or liability. So we don't have to put into the current tax reconciliation. The question which we should ask to ourselves is the reconciliation to the total tax expense, including a current deferred tax, rather than just current tax expense. Does the tax reconciliation incorrectly contains items that are not in fact reconciling items? A temporary timing difference is reflected in deferred tax asset or liabilities, and therefore it should not be a reconciling item. We have touched upon certain related party transactions. Let's look into two more issues when it comes to this. I think the first one we have discussed. Maybe quickly you can go through it. Then we can go to the second one. Let me take the second one, which is particularly IS 24 para 9, and what it says that where an entity has acquired or disposed of a subsidiary during the period, or it has increased or decreased its ownership stake, or to from wholly owned, it must consider which transaction are disclosed as related party transaction. Disclosure can be different for related party transactions during the year compared to the amounts due and from related parties at the year end. So it's not necessary that if the balance at the year end is less, still the transaction can be of higher amount. So earlier, I think Sanjay Saab raised this question that if I transfer money, get money, will that be a related party transactions? Yes, that will be also related party transaction because giving funding, taking funding is a transaction, and therefore it should find a place. And particularly now it's more important when you do the transfer pricing benchmarking. These all will come under that. However, in the past, we have seen that these were not disclosed as transactions, but generally this will find place in some cash flow where you account for cash received from related parties, cash given to related parties. But yeah, now probably it will find more place in the related party disclosure itself. subsequent events, no, I think this is not done. So this ends the presentation for this. Some of the disclosures, errors or inputs which I found to be useful to share with. Obviously, there are many other disclosures and there are big checklists by each of the big four. We can download and send to you in the focus group if you want. And some other day we can take some more disclosures. But as of now, these were there. Let's quickly go through the disclosure relating to the corporate tax extracted from the two listed companies. Then we can go to the question and answer round. Balram would like to take.
No,
Probably
Anuj, I
Balram.
think, I'm stuck with something else. Please, if you can continue.
I'll just quickly move and you can.
Yeah, sure.
You want me to give you access?
No, I'm stuck with another meeting, so it's
okay. So I can take it then.
Yeah, please.
Okay. So these are the disclosure from the SPINNY's financial statements. This is the accounting policy of the current income tax. And we can share you this disclosure in the WhatsApp group. If you allow me, I'll just quickly run through it rather than just reading it out. You can have a look at it. And if there is any observation, we can discuss.
Yeah, so these are the standard disclosures that were there with respect to the taxes. So since this is first time that most of the companies will be doing here, so we thought of showing how the disclosures have been done, just for your understanding purpose. I'm sure most of you must have gone through it, but just for the benefit of others who have not gone through it.
So if you see your total expenses will be sum total of current income tax charge and the deferred tax. Then you This is how a reconciliation of tax charge is given. It starts with the accounting profit. And then some adjustment related to the higher overseas tax rates and losses. And if you see, the effective tax rate then comes to 10.23 instead of 9% in UAE. And below is the disclosure given that up till 375,000, there is no tax. So there is a standard deduction of 33,000 dirhams. This is the accounting policy of deferred tax. Which is continuing. It talks about deductible temporary differences with the various other items. And this is how disclosure of deferred tax amounts has been given. And if you see, there is a breakup between deferred tax on what deferred tax is for. So there is an accelerated depreciation and then provision and reserve. So these are the two items on which deferred tax asset is being created. And below is the proper disclosure that how these losses have arose, mainly from Oman and Kingdom of Saudi Arabia. And the fact is also given that deferred tax assets have not been recognized in respect of these losses, as they may not be used to offset taxable profit elsewhere in the group. So when you're not accounting for any deferred tax asset, you should always give the explanation that why you think you should not account for it. This is the movement of deferred tax asset from the beginning to this. And we can see that this company, although this is the first year of tax in UAE, but still it was having the opening deferred tax because of the opening items. And then the company also finally disclose about the pillar two rules, whether they are part of it, what is the status of implementation in various countries, including UAE.
And they've also clearly mentioned about the disclosure exemption that is given in IAS 12 with respect to this pillar 2 rules.
Yeah.
The last paragraph is about that.
Similar disclosure we have extracted from Emaar Financial, which is mainly to real estate.
I am.
Yes, Lakshmi. You have any question?
Maybe I think it is by mistake.
Okay. So this is again the accounting policy of deferred income tax, running into pages, and also about the UAE federal degree law, then the reconciliation from the beginning to the end, and then both the deferred tax assets and liability shown separately. This is for the current tax, starting from profit before tax, coming to the taxable profit. And ultimately disclosing effective tax rate. You can see a big change in effective tax rate last year, 22.58, because UAE was not there. But since major operations are UAE, the effective tax rate have reduced. And then the general description about the ministerial decisions, and then again, global minimum top-up tax, certain disclosures. And here, if you see the last line of first paragraph, the group falls within the scope of these rules from 1st January 25 and is currently assessing its exposure to these rules. That's it. If you want to discuss anything on disclosures related to tax, which I think is self-explanatory, but if you want to discuss, Balram will be happy to answer.
I think more than disclosures, how do you compute is, I think, is challenging thing. And identifying for which all accounts or where do we have these different tax assets and liabilities is also a challenging thing most of the times.
Yeah.
Presentation wise and disclosure wise, I think not that challenging as compared to calculations.
I think one of the important challenge will also be that if you are a group registration, then how to allocate the ultimately tax exempt to various entities when you're preparing their standalone financial statements.
Yeah.
With this, these were some of the questions raised by some people sent in advance. Maybe if they are online, we can take so that they can explain it in better manner. Mr. Janak, are you there?
Janakji, are you there? I think.
No.
Yeah.
Then
he is there, but I don't know if he's.
we can read his questions.
Yeah, so let me read it. Shareholders' current account shown part of equity in the financial statements and included in statements of changes in equity. Whether now interest can be paid on such current account balance or it can be removed from one of the components of equity as per financial statements. So
Yeah,
if it,
I would first like to understand from him, but since it's not online, so first of all, it says current account. And as we discuss current assets, current liabilities, I believe current account is something which can change on day-to-day basis, right? So in my view, first of all, it doesn't meet the definition of equity because equity is something which have only the residual value. And it should be paid at the discretion of the company and not at the discretion of the shareholder. But if that's a current account, that is also interest free. So this is something which is, I think, is liability to the company, which needs to be assessed in a separate manner.
I think yesterday I happened to meet him and then we discussed about this question. What he
Okay.
means to say is that once it is classified as part of the equity and you're showing it in your statement of changes in equity also, so now if company wants to consider that as loan and then consider interest on that to get the benefit from tax, can they do so? That's what I think is the intention.
But I think for that, first of all, the company has to repay the equity. If it was disclosed in the equity, the company first repay that, and then probably the shareholder will again give it as a loan or maybe interest-bearing loan on which company will take. And then I think the normal transfer pricing rules will happen.
Yeah. So which means as is we cannot do it. It
Yeah.
has to be repaid and
Till the
then
time it is classified as equity, because equities can only participate in residual interest. How can a shareholder charge interest from his own company, particularly when it is classified as an equity? That is something which probably will not be allowed, because
Anis, can
then
I
it doesn't
discuss?
meet the classification of equity if the interest is being taken.
Anis, can I discuss further on this question?
Yes, sir.
Anis, see, most of the companies in UAE, okay, they are showing as a shareholders current account as a equity in their financial statement. So, with generally in the private limited company, okay, there is nothing like a shareholders current account and such things. So, whether it should be disclosed under the liability or it should be under equity, the way you explain, okay, it should be in liability. So, it should not be in the shareholders equity.
Yes, sir.
So,
If the agreement is such that the shareholder has given the money and on which he is charging the interest, and particularly it's classified as current, which means it can be repayable on demand. Whenever he wants, he can take it back, which means it's first of all, it's current liability and interest is charged on that. Therefore, it should be classified more as a liability and not as an equity.
but if interest
Generally,
is not
earlier interchangeably used to put current account under the equity, but general tendency now is that current by word cannot be equity.
let's say there is a no interest charge. Actually, company cannot run with the 300,000 capital and retain profit. It is in real sense, it's a working capital amount. Okay, and there is a no interest charge on that. Okay, and it is lying continuously since many years, and that is a normal
Agreed.
business
And we
working
have seen
capital.
many companies having this. So
Yeah,
generally, different terms are used by different companies. Some use as additional funds, some use as additional capital contribution. Earlier, definitely it also used to be current account, but now I think current account they don't use it. But yeah, in a way, it's an additional equity which is not registered, which is
yes.
put into this thing. So an agreement has to be there between the shareholder and the company, and all the items should be there which can classify that as an equity.
May I
Like,
come on with this, sir? Prem Jain here.
yes, sir, Jain sir.
Sir, generally banks are taking one undertaking from all these partners that this much amount will not be withdrawn. That is treated
Yes,
as loan. On that loan, interest can be charged. That is part of equity. At the same time, it is liability. And this is practically done in most of
now
the companies.
how it is classified in the financial statements?
It is shown under equity only, but it is
Then you
shown as
cannot
loan,
charge
partners
interest.
loan. Sir, please. It is shown as partners loan, and undertaking has been given to bank that this much loan will not be withdrawn until bank's liability is settled. On that, interest it can be charged, in my opinion, because it is loan only, but it is like equity, not exactly share equity, share capital,
Then
but
what's
it
the
is like
difference
equity.
between liability and this amount?
If I show liability, then net worth of the company is reduced, and banks don't like this.
So basically,
That
it's
is the
not
main
part of net
problem.
worth.
That's the main problem. Now, strictly, if you talk as IFRS, you are the better judge how we should show.
Yeah, IFRS, we don't have quasi equity, we don't have anything, something. We have either assets, liabilities, or equity. So you need to assess based on the definition of equity. And equity is something which should participate only in the residual interest. So definitely, many companies I have seen that this amount has been uh, bank having their agreement mentioned that this amount will be considered equity and they cannot withdraw unless the loan is repaid.
That's correct.
But definitely it's not that the interest has to be paid. So if you want to classify as equity, remove the interest element and also give the discretion to the company to repay it rather than shareholder demanding it. So eliminate all the aspects of liability and then it can be equity. So an agreement can be made in that aspect. Ultimately, we all know that shareholder is the company and company is the shareholder. It's
No,
only
that's
the
not
manager.
that's not the idea. The idea is, if now in corporate tax 1/3, interest is allowed as expense, why not people will plan that way to show all these
But
additional
as an auditor,
capital
we need to
as
see how it meets the definition of equity. So classification issues will be there.
okay.
I
So
think
we have to find some way out, in my opinion. Some middle way has to be found, so banks can be satisfied, at the same time tax planning can be done.
I think it will be even more interesting because in some companies we see that instead of funding more money, sometimes owners may take more money from company than the equity, in which case the current shareholders' current account becomes negative. So if that is the case, it will be like the authority, the FTA would be interested in knowing it amounts to be a
In
loan.
that case, company is losing the
Sir,
interest.
their track,
Yes,
TP will come. TP will come in play if you have charged more interest. So that is not the issue. That is different calculation.
but see, if you are showing it as part of equity, negative,
Yeah. No. So
which
yeah,
otherwise should be considered as loan given by company to the owner. So
we,
in which
we,
case
we
you may
should
end up in
find some
having
way out.
income.
In my opinion, we should find some way out. So tax planning can be done, at the same time bankers can be satisfied, and at the same time
Ultimately,
IFRS also is not
how you
there.
disclose this balance in the financial statements,
And
FTA will
IFRS
need to look on
also,
that.
as per IFRS also, if I show under the head equity and then I say loan, then on loan interest can be charged. I don't see any problem in that.
But how loan can be equity? That's what I'm saying.
Because we have given undertaking, it will be like a part of
No, just
equity. It
giving
cannot be. It
undertaking
cannot be
to
withdrawn
bank, just
for
giving undertaking to
unforeseen
bank
time.
doesn't mean IFRS, you are compliant with IFRS financials.
One thing.
There only I am saying we have to find some way out.
No, so you will be stuck because it says in lieu of dividend, if you try to take interest, FTA has a specific clause on that. So you need to consider that as well. They have already,
Definitely.
what you are thinking has
You
already been thought about by FTA.
Yeah, definitely.
you want to save tax also, and then you want to take more dividend also.
Anyway, we have to find some
It's a
planning.
contentious issue, and
Yeah, that's what I'm saying. Because we are not sitting in exams, so we should be very theoretical on IFRS. We have to see practical way and how to make tax planning.
No, I think here if the amount cannot be withdrawn, it is more in the nature of equity than loan then.
That's what I'm also saying, boss.
yeah,
So then there is
but
no
taking
planning of
interest
tax.
itself means you are not participating in residual interest. That also we are forgetting.
Anish,
Equity by nature should always be the last one to take the money.
Anish will not be considered as a substance over form when there is only 300,000. If you remove that capital and show under the liability, and really that is a capital, okay? And we are showing because of that reason under the equity without interest. So
Yes,
that is
without interest is something which you there, and then you also have an agreement that this will be withdrawn only if the company will have sufficient funds, not the shareholder can demand any time.
yeah. So
So
will
all
it
these
be
conditions can be put in the agreement, and accordingly you can classify as equity.
and is it need to be disclosed in the financial
Yes,
state?
generally when the amount is big, you will disclose the nature of this, that these are in form of additional capital contribution for the long-term capital requirements, interest-free, probably cannot be demanded by shareholders, and probably will be paid when the company wants to pay it.
But
So will
shareholder
it,
can put this condition that interest has to be paid until I'll not be able to remove. In my opinion, there should not be a problem.
I
And
will
corporate.
never agree to you that if interest is paid, it is equity.
Can
so
I
by
also comment on the substance over form? This
Yeah.
mechanism, isn't it a mechanism to enhance the net equity, particularly for showing a shining balance sheet to the
That's
lender,
correct. That is true.
right?
That is true.
So
So
if
window
the
dressing.
substance over form is that intention is not right, you are
No, intention.
misrepresenting
Why
your net
intention is not
equity.
right? How much money is invested? to earn this profit,
No. So
to
that
run this
invest,
company.
it's not invested. It's a current account. So
I'm
we
not
will
talking
have
current
like
account, sir. It can be converted into loan.
Sir,
so
if
it
I
is not
may
There are,
instead of
interrupt, this
equity.
can go on and on because we will never reach to a
Yeah.
conclusion.
but there are practical reasons for showing it as current account because
Okay, only one question, small question. What
Yeah.
about preferable shares? There also some percentage is paid, but that is shown as under equity.
Yeah. Preference share is generally, in my view, not issued to the same shareholder, right? It can be issued to anyone.
That's okay, but I'm saying there is also some percentage to be paid, no?
Yeah, definitely. Interest is there, redeemable, non-redeemable, cumulative, non-cumulative.
That's correct.
Anis, when we are
Let's
showing
let's
and
go
disclosing,
let's go to the next one.
one last question, okay? It may
Yeah.
not be related to IFRS, but let's say we are disclosing, okay, this residual interest, not. Will it lose the limited liability commitment by LLC? Means their capital will be under the liability.
Sir, we all have seen, and probably I cannot say what is exactly because ultimately we have seen these big amounts are sitting in equity and we are disclosing it also. Now, how after tax this will be considered, we have to see in a year's time.
Okay.
But still, financials are being done based on big amount put under additional capital contribution shown under equity without any interest, and then total amount is shown as equity. And sometimes people for the meeting covenant also consider this into tangible net worth.
Yes. Most of the bank it is considered like
Yeah.
that. There is nothing. If they remove, it won't be possible. That equity ratio will be totally changed.
Yeah, I have certain limitations, some things I cannot disclose here.
Yeah.
And also, these are only my views, not my company's views.
Yeah, I think since we have another 10 minutes more, let us just complete our
4 minutes
focus on our
more, 4 minutes.
questions. Okay.
Hmm.
Yeah, 4 minutes more. The other question from Zuzair Netherwala, whether corporate tax liability is mandated to be disclosed on the balance sheet date in the audited financial statements. If
I
yes,
found it
how
very tricky question. Maybe there's something because I don't understand.
tax liability is mandated to be disclosed?
Probably he wants to say tax liability as a separate line item to be disclosed. This is what I understood.
Okay. So that depends upon the materiality, right?
And both, like even the tax
Significance.
expense should be shown separately in the P&L. This is what I think. In my view, tax liability can be clubbed under provisions, but in the P&L, definitely tax expense has to be shown separately.
Yeah.
Is he there? User is there or he is left?
This is, he is
Let
not
us
there.
take the questions which people are here.
Okay. So,
I think it should be under OCI, correct? The tax expenditure should be under OCI.
Why? It should be
The
normal
tax part.
tax
tax part
expense.
to corporate tax.
Yes.
Tax
How?
part of items under OCI will be in OCI, but corporate tax definitely will be main P&L.
Corporate tax expense will come in P&L only, no?
Yeah. That is how you calculate profit after tax.
Profit of.
Any one of these people are here? I think Vishal
Vishal ji was here. Yeah. Yeah, he's still there. Yeah,
Yes,
Vishal ji.
please.
Just
Vishal, you want
Yes.
to raise this question now?
Yes, Anish bhai, I think you covered this already. I think this
Okay.
funding transactions, you were saying that it has to be included.
Yes.
But then the
Both
only
plus and
question
minus.
is, I mean, how do the clients, I mean, and so much funding transactions will happen between group companies. How do the data will be provided? What will be the
Basically, you
accuracy
have to
level?
take the ledger printouts, you have to sum it up.
Yeah,
Plus, also, this will also be dealt from the transfer pricing point of view also. Whether
yeah,
these are the normal trading transactions, whether any interest is charged, then it's at market rates or not.
agreed.
All
Yeah,
companies have to build their systems now according to this.
okay.
Either they will build now or once FTA will come. then they will build.
Okay. Thank you.
Tejas had questions. So Tejas, I think he left.
Okay. Anyways, I have no idea on qualifying freeze on entity disclosures. We have not seen
About the
yet.
policy disclosure and financial statements of qualifying freeze and
Pillar 2,
entity.
we have already shown some extracts. So they can have a look at it for the Pillar 2 disclosures. In particular, UA, it has not been implemented.
Yeah.
Finally, just a last slide, because a lot of us must be working on the finalizing the financial statements. So we generally give note 2, where there are certain standards which are applicable for the year, which might have impact or no impact on the financial statement, but this needs to be disclosed. So these are the 4 changes during the year, which is impacting financial statements on or after 1st January 2024. People can take note of it. If they want to discuss something on this, we can discuss. Otherwise, we can close out. Unless they have more questions online right now.
I think I'm just searching in the chat box. We missed some of the questions in
I think
between.
it's a dinner time also. I think people must be hungry.
I have one question, Anish ji. I
Yeah.
think while one of the sessions which we were attending for corporate tax, there was one of the presentations. It mentioned that as per corporate law, the remuneration to the key of to the managers actually, because there is no definition. If I remember it, is cannot be more than 10% of the profits. So
I think it was for the public joint stock companies and all. With respect to them,
That
there
was
was
probably director sitting fees, I guess.
no, it mentioned remuneration. That I remember correctly. It was not
Or
in
maybe
specific.
remuneration to directors, including sitting fees, something like that.
Yes,
It
Yeah.
is including federal law. It is federal CCL. I
Yeah,
think
corporate law. Yeah, as
273
per
or
the
271, the limits are defined in that. I think corporate tax law does not directly define the limits, but it refers to federal law, if I'm not wrong.
Yeah.
Balram, you
Not
correct me if
corporate
I'm.
tax, not corporate
Yeah.
it
tax,
was
but yes,
mentioned
the
in the
law.
commercial law.
Yes, commercial companies law.
Companies Act.
But
Yeah.
what I have seen for corporate tax, many companies, they are now getting benchmarking done for their management remuneration. So that then they can book this as an expense and claim tax deduction on this.
Yeah, for all other than
Each company
PJs.
will have different remuneration. One size cannot fit all, because one owner might be very influential, whereas the other owners is not that influential and have less number of businesses. One can have more number of businesses. How much value he's adding to the business, what job description he has. So accordingly, the proper benchmarking studies many companies are doing, whose management remuneration is quite high. So this will be an additional exercise to be done by the transfer pricing experts.
Yeah, in fact, yesterday only we were discussing about this. So, irrespective of the amount, whatever payments that we generally make to this connected persons category, generally you need to look at it and make sure that it is at market value or market rate. For that, it is not easy, as Anish mentioned. Case to case, it varies, and you need to have proper documentation to support and demonstrate that it is at market rate. So, for that, qualitative factors as well as quantitative factors need to be documented, and then accordingly you'll be able to demonstrate it.
Proper job description should be there, what he's doing, what value he's
What kind
bringing
of
on the
services
table.
is, yeah.
Each
Yes.
business can be different. Like Emar cannot be compared to Damak, because Damak might have different businesses, Emar might have different businesses, including mall management and all. So many aspects will go, a lot of database will be considered
Yeah.
while deriving this amount.
In terms of quantitative analysis, then we need to see what is the profit or taxable income that is offered after adjusting all these amounts. Is it in the range of industry or not? That's what FTS finally is interested in.
That brings the same point that he cannot take a certain percentage of profits and then leave nothing for the FTA.
That's right, yeah.
So many
Anishji, I have
areas
one
which will be
question.
considered.
I have
Yes.
one question about these new and revised IFRS, particularly for the listed entities. Now, while we are finalizing the financial statements and completing the audit, these have already become applicable on the companies.
Yeah.
Do you think the standard requires, or is it prudent to disclose something more than this? What the companies have done to implement these changes, particularly when the change is a material or it has a large impact, at least on
Yes.
prudent basis?
So on adoption, if it has an impact, definitely that needs to be disclosed. Generally, what I have seen in the small private companies or medium-sized companies, they mention this, and then ultimately at the end there will be a disclosure that these implementation of these did not have material impact on the financial statements. So but the standard requires you to disclose the impact which these standards have bring to the financial statements.
Thank you.
I think we are more or less done with all the questions. If
We
there
started
is
5 minutes late, we are ending 5 minutes late.
yeah, so I think we addressed pretty much what we wanted to cover. So if there are any other questions, you can quickly ask now. Otherwise, I think we will end
We
the
can
session.
discuss on the focus group also.
Yeah, we have focus group.
Should I take one question?
Please,
And
sir.
it's
Yeah.
just see, this is specific to the gold and diamond jewelry industries, okay? Where generally goldsmiths are, as per the VAT, they are issuing the jewelries invoices with the gold value, but in real sense, they are getting the back paid the gold itself, okay? So there is only labor charges is there earning. Now, what is there vis-a-vis the wholesalers is sells that jewelry to the retailer with a full value, including gold and the labor charges. But back to back, the retailers pays in the gold. Okay, and that gold payment in gold, which is happening, also accounted as purchase and sales. So there is a duplication of the purchase and sales happening. But since the tax invoice is generated for both the bullion payment, okay, payment in gold and receipt in gold, will it be considered as a sales and purchase, or it should be netted out?
See, generally, let's take first retailer first. What
Yeah.
invoice you are issuing and what payment they are making to you. They
See,
are making you both for gold and making charges.
See, retailer is doing the sales in gold plus making charges. That is to the end customers.
Yeah, and customers I'm talking.
End customers is a gold plus making charges, and it's a
Your revenue will be recorded at that amount, right?
Yeah, that amount will be recorded.
And if you record revenue at that amount,
Mm.
then obviously the cost also have to be recorded, including both making charges and gold.
Yeah, that is a purchase. Okay, so he is making a sales of the bullion to the wholesaler because he's making a payment in the gold. So that sales also will be become the retailer sales.
Is it a sales or just a settlement of gold to gold?
It's a settlement in really gold to gold. If you
Then it
go,
won't meet the definition of revenue, I guess. Only thing is one thing you are buying from him and you are replacing it with the gold. You are
no,
buying
I'm
jewelry
buying.
and replacing it with gold.
Yeah, but I'm buying from bullion people and paying to my wholesalers. Okay, so there is a purchase of gold and there is a sales of gold. And for both the transaction, there is a tax invoice is generated. It's not a really a settlement of the jewelry what he has purchased. It's a part
And
of
in
that.
between, is there any margin?
See, margin is always it's traded as market rate. Okay, so it's considered like their margin is there. But while buying the bullion, at that time he has thought of the margin and purchased at the lower rate when he has planned that it is now lower rate. So he has purchased. So it might be considered that the margin lying in buying, but it looks like that there is no margin.
Maybe if it's within the same period or within a short period of time, probably margin won't be there. But if the time gap is there, probably margin can be there. So all these agreements have to be separately assessed and see whether it can meet the definition of revenue recognition.
As far as revenue recognition is concerned, all 5 steps is covered. Okay, the rights and everything is done. Then the derivative contract is made for the reversal of the purchase and gold values. Okay, as per the tradition of the transaction in the market. So the gold is
So you
lying
issue
as
credit note or debit note for that or what?
no, there is another gold fixing transaction. Derivative contract is made for the reversal of the purchase. So the now the gold is outstanding. with the wholesalers. Okay.
I think this is specific to a particular industry, but again, if the contracts can meet individual criteria of purchase and sales, you have to account for that. But I think we need to see all the arrangements, and accordingly, we need to see how it can be classified.
So maybe I think it is better to take off.
With the different parties, definitely you have to understand whether it's an agent transaction or a principal transaction.
Yeah.
No, it's a regular buying, selling contracts is happening.
If you are the principal in all the cases, probably you will have to record for this transaction at gross values. But we can discuss offline on this.
Yes, sir. Yeah. So in the interest of the time of others, yeah.
One last important question. One last important question. Is it unstructured or structured learning hours?
For this, we applied for CP hours and then they approved. I think people who have registered.
They have approved?
Yeah, they have approved this.
Generally, virtually, they don't approve, so I don't know.
If it is not credited, you can apply for it, you will get the credit.
One question I can raise.
Thank you.
I think one last question, sir. Yeah.
Yeah, the only one point that some investment in foreign currency exchange difference is recorded at the year end. So that has to be separately shown compared to currency exchange difference. Other OCI after OCI and in OCI and in normal.
You mean to translation adjustments for converting subsidiaries financial in your report?
I'm talking about the current assets, which is in foreign currency, which is to be restated to the year end. So that exchange difference, it will be OCI or normal exchange difference.
No, this generally goes to the profit and loss account. Conversion of the foreign currency assets and liabilities, foreign currency assets and liability generally goes to P&L. However, while doing the cash flow, you should eliminate this because this is not cash transaction.
And for currency?
For currency, we have discussed currency means foreign currency which you have in your hand, right?
Yeah.
That should be shown as a separate line item as the changes in cash and cash equivalents.
For in other comprehensive income or?
No. Impact will go into P&L only. I'm talking about the cash flow.
Okay.
Yeah. I think, so we are done. In fact, we have covered more than what we were expecting to, and it has been utilized effectively. Thank you very much, Anish ji, for your wonderful contribution. We discussed only for 2 hours, but I think the impact was more than that for sure. If it was in person, I think we couldn't have discussed so much. So once again, thank you very much for taking
but
out
before
time.
people leave, I would like to particularly thank you, Balram, for actually pushing me to do this. Otherwise, we would have waited for another 2-3 months for this. But thank you so much for giving
It's my
this
pleasure. In fact,
opportunity.
I wanted to have this. I wanted to have this kind of impactful session so that there will be a lot of value addition.
I generally like to interact rather than just talking and just reading out. So
yeah, I think today we have seen that. Thank you very much once again, and thank you all for joining us. And,
thank you, Anish ji.
Once again, thank you,
welcome
Anish ji.
everyone. Thank you.
Yeah,
thank you, Anish. Thank you, Balram.
Anish ji.
Thank you, Balram. Thank you very much.
Yes, sir.
Anish ji.
Yes,
thanks.
please.
Sir, sorry to disturb you at that. Just a small question regarding that material uncertainty clause which you told. So, just like as you told that based on the conditions we need to evaluate and accordingly have a note in the auditor's report page wherever there are some instances of material uncertainty.
Right.
But at the same time, sir, it will also differ in case of industry to industry. Because, for example, just wanted to understand.
Principle of audit opinion will remain same. Principle of audit opinion will remain same. Basically, you have to convince yourself as an auditor that whether you still feel going concern is appropriate, management is able to convince you. If management is not able to convince you, don't give you proper plans so that you can evaluate going concern, then probably it will be a qualification. Otherwise, if you are satisfied, probably you can either live with nothing or you can just give an emphasis of matter, just highlighting this thing. But you will also mention that you are satisfied yourself with either support letter or something else.
Okay, sir. Got it.
Yeah.
All right.
Thank you, sir.
Thank,
Thank you.
thank you. Thank you all once again, and have a
Thank you
good
so much,
evening.
sir.
Thank you, sir.
Thank
Thank you,
you.
Anuji.
Good evening.
Once
Thank
again.
you.
Yeah. Bye. Thank you.
Bye.
Thank you.
Yeah,